Welcome back, everyone. Thanks so much for tuning in. I know I haven't done a video in a little bit, so I figured today I'm just going to show you my investment portfolio. I'm going to show you my individual brokerage account as well as my IRA, kind of the difference between my holdings in both of those, as well as the difference in my investment philosophy between the two of them. And then at the very end, I'm going to share some stock picks that I've been researching and might, see adding a position in my, brokerage account. So before we get started, I just need one thing from you all. Please hit that like and subscribe button. It will really help me grow the channel and keep being able to provide this content to everyone. So let's dive right in. So you see that my current portfolio is $40,622.24. It was a little bit higher when I made the thumbnail for this video. So if you see that difference, that's why. But then you also see this big spike right here. I used to have all of this in a Schwab account, but they didn't have all the features that I wanted, so I ended up switching it over to Fidelity. So let's just dive right in. Look at what I'm holding in each of these. So switching over to my positions, we can see these positions are all for my individual brokerage account where the majority of my funds are, and they're sorted by cost basis. So you see Amazon, I have almost $8,000 in, almost a quarter of my entire portfolio. And then, it just goes down the list from there. You can see a lot of pretty standard holdings like Amazon, Meta, what are a couple other big ones? AMD, Nvidia, Nike, Adobe, right? And then I do have some smaller ones, right? SoFi, where's SoFi right down here, is something that I might potentially be adding a little bit more to. Molina Healthcare, HCA Healthcare, all some great stocks. I can filter it by gain and loss, and we can see which ones are performing the best. So we see ELF has just been crushing it for me recently, up almost 60% in ELF. Actually, if we look at my actual positions, you see I have 38 shares at almost $53, and that's gone up just under 60%, which is incredible. So really happy with this portfolio so far. I might be trimming some of my smaller positions, like smaller cost basis positions, just to kind of shrink my portfolio and put some more funds into the stocks that I really feel are going to do well. And then here at the bottom we can see year to date. I started this portfolio in January, so all of these values are year to date right now. I'm up just under $6,000 and almost at 18%. So if we look at the S&P year to date, we see that they're down 1.12%. So edging out the S&P by just under 20%, which is pretty good. And then down in my IRA again, I'll filter this by the cost basis. So like I said, I had all of these funds in Schwab beforehand. So the Schwab S&P mutual fund is what I have, the majority of my holdings in, over half of this portfolio. But then you see over, a quarter of my portfolio is Amazon again. So I do have, a large holding of Amazon in both my brokerage account and my IRA. And then you see a bunch of these are all kind of smaller positions, right? It's because I just added these this last month, actually. So we're going to talk about why I added these and why I don't necessarily have them in my brokerage account. Okay. So we're going to come over here. This is Qualtrim. This is a kind of analysis tool that was made by Joseph Carlson, who runs the Joseph Carlson Show YouTube channel. Great YouTuber, love listening to him, and I've seen him use this software in a lot of his videos, and it made me want to subscribe and use it, and I love it so far. So maybe we'll see a review of Qualtrim in a future video, but we'll see. Let me know down in the comments if that's something you'd be interested in seeing. So talking about my IRA versus my brokerage account. Okay, now I do subscribe to the value investing idea, right? Warren Buffett's, pretty much what he's been pushing since he's been investing is the idea of investing and buying companies when they're at a low valuation compared to their intrinsic value, right? What the company is actually worth versus what you're able to buy it for on the stock market. So usually you want to buy it for the cheapest amount possible while the company is still worth a lot, right? It's the general premise of value investing. And all of these stocks that I'm holding in my brokerage account are, follow that principle. I bought them at prices that were attractive to me that I considered a good value based on what I, valued the company as a whole, right? Not just the stock price. So all of these were priced attractively for me to buy, and so I did. Now, the difference is in my IRA, right? I didn't really pay too much attention to valuation. I paid much more attention to the fundamentals of the company rather than the current valuation and what I would be buying the company for that day. So we see like MasterCard, Microsoft, Netflix, Costco. I bought all of these at the beginning of May as new positions in my IRA, and a lot of those are pretty close to all-time highs, right? So even if you're brand new to investing, right, buying a stock at its all-time high price is never a good idea, right? But I did because it's in my IRA, and I'll explain why. Now, traditionally, right, when you have an IRA, and we'll just talk about a traditional normal IRA, you're not able to touch those funds until you retire, right? So both your contributions and the growth on those stocks, right, the growth on your contributions, you can't touch until you retire at risk of paying taxes and fees and everything for it, right? So with that idea in mind, right, IRAs almost force you to be a long-term investor, right? Even if you're not particularly good at being a long-term investor and you still feel yourself being swayed by the stock price and emotions, fear, excitement, things like that, an IRA almost forces you to be a long-term investor because you can't touch those funds yet. So that makes purchasing some of these stocks at a higher valuation much more palatable for someone like me, right? I know that based on Microsoft's fundamentals or MasterCard's fundamentals, that they're going to continue growing and improving as a company over the next 30, 40 years to a point that their share price at that time is going to be much, much higher than what it is today. So I know that even if Microsoft goes down in the short term, even in the next 10 years or so, because their valuation gets too high for their company, I know that in the future, when I'm actually going to be taking money out of my IRA, it's still going to be worth much more than what I bought it for this month. So the idea that you can't touch your IRA or other retirement funds until you actually retire helps you kind of see past valuation a little bit and just be able to look at the company itself. You can't really sell and take profit from those gains, so why not just hold on to them for the long term, right? And if you're going to be holding on to them for the long term, you need to make sure that you're holding companies that are strong, they're durable and reliable to get through the difficult times that are coming in those next 40-something years, right? So I know a company like Microsoft is going to do well in the next 40 years. So I don't mind paying a higher valuation for it now when I'm not even worried about them until 40 years from now. I hope that makes sense, right? In my other brokerage account, I took a little bit more risk and a little bit more of a value investing approach where I waited to buy a lot of these companies until they were at a good value. And I bought companies that were already beaten down, some like Whirlpool, for example, that were already really undervalued. Now, I wouldn't want to necessarily add those to my IRA because they're a little too risky for me to put in my IRA, right? If everything, if I were to lose everything in my brokerage account, I need to be able to rely on my IRA when I end up retiring in my 60s, in 40-something years from now. So I need to make sure that the holdings in my IRA are strong companies that I trust and that I know are going to continue to do well when I actually need them. So that's a little bit of an explanation as to, the different investing philosophy versus, for a brokerage account versus an IRA. You still want to focus on valuation, right? You don't want to be buying extremely overvalued companies in your brokerage account, but you can get away with slightly overvalued companies in your IRA, I believe, right? As long as they're solid companies and you're not paying too high of a valuation for them, then I say it's definitely worth adding them to your IRA. Now, a company I wouldn't add, for example, is Palantir, right? Palantir might be a great company, but when we look at their valuation, they're trailing 12-month PEs over 500. Okay, that's way too high. Even to add that into an IRA, right? So it is kind of a game. You still want to focus on value investing, but when you're dealing with your IRA and you still have 30, 40 years before you can even touch those funds, you can let valuation slide a little bit, so long as you're just adding positions and growing positions in strong companies like Microsoft, Amazon, MasterCard, right? Companies that you just know are going to do well. So that's the difference between my IRA and my brokerage account, right? I'm willing to take a little more risk here, and I'm willing to spend a little bit more in my IRA. So those are the main differences. Now, last thing here in this video that I want to show you is some stocks that I've been eyeing and might potentially be adding to my brokerage account. So you see here, this is my wait list in Qualtrim, right? Stocks that I'm keeping an eye on that I might want to add more to, but I just need to research them more and see if it's worth adding additional funds to them. So you see like SoFi and Celsius, I already have positions in. I just need to wait and see if I want to keep building those positions yet. But the ones that I really want to focus on are all of these energy companies like AES, HCC, NRP, REPX, and VAL, okay? And the main reason is because of this right here. Trump administration kicks off plan for expanded offshore drilling. This kind of goes hand in hand with Trump's tariffs and his goal to bring these companies back to the United States, right? Now, one of Warren Buffett's famous quotes, and I've said it before in my videos, is to be fearful when others are greedy and greedy when others are fearful. And this kind of has two different approaches you can take to it. The first is in the market as a whole, right? When you're going through a crash or a bear market and people are fearful, that's a great time to be buying stocks, right? And that's exactly what I did this year back in April. But there's also another more subtle explanation for this. It also has to do with market trends, right? Right now, we see everybody being extremely greedy on AI, right? That's a huge spend right now. It's actually shaping up to kind of build an AI bubble that I think is eventually going to crash, but I will definitely be doing another video on that pretty soon. But taking Warren Buffett's idea, if other people are so greedy for AI, that's a time to kind of sit back and think a little bit about what might be happening with AI, right? And you can start looking in places where people are more fearful. And one of those places is energy. And specifically, the dirty type of energy, like drilling, fracking, and coal, okay? With everything going on with electric cars, renewable energy, AI, that's where everybody's gravitating to, and you see people leaving places like coal and oil, right? But that's not going away anytime soon. It's people getting greedy for AI and fearful of coal because of all these new fads. They're still fads right now that are coming out around energy. So that's driven me to look much deeper into some of these traditional energy companies, right? Even when renewable energy takes off even more than it has already, we are still going to need coal. We're still going to need oil and natural gas, and a lot of these companies aren't going away, especially when all of the big tech companies and home builders and everything start ramping back up and coming back to the United States. We're going to see the need for this type of energy skyrocket, right? Now, the last thing that I want to point out with these companies too is the interest rate from the Fed, right? Now, we know that the Fed is eventually going to lower interest rates again. That's a fact. They always, whenever they raise them, they end up lowering them again. They'll raise them and lower them again, for the rest of the Fed's existence. So when they inevitably lower rates again, that's going to trigger an increase in home buying, home building, and people moving, right? And those three things are going to contribute heavily to the use of coal, natural gas, oil, and all of those types of energy resources, which again is going to benefit all of these energy related companies. And then the last thing are companies like Whirlpool, right? Whirlpool has been beaten down recently over the past several years, actually. You see, these aren't exactly accurate on here, but you see an 8 and a 7 PE, right? That's much closer to what Whirlpool is right now. And it's because people haven't been moving, they haven't been renovating houses, they haven't been building new houses yet. And so no one's really needed appliances from Whirlpool, right? But again, looking forward, when these interest rates come down and people see their purchasing power increase, this is exactly the type of company that they're going to be buying things from, right? So Whirlpool is set up perfectly to be a great stock for the next 5 to 10 years once these interest rates start to come down a little bit. So that's just a overview of some of the things that I'm looking out for. Again, the dirty energy companies like coal, oil, and gas, and then cyclical companies like Whirlpool that have a close-knit relationship with home building and the home appliance industry. So that's my take on those. Hopefully you guys enjoyed this video. I know it was a quick one and I haven't released in a while, but thank you so much for listening. And comment below any questions you have or any stocks that you're looking into for the rest of this year. Thank you so much.